Welcome to this Killick Explains video. Now I should say up front that I don't want to do politics as part of a Killick Explains finance video. However, there is something I do need to mention around about now, early March as this video goes out, possibly ahead of another budget from Rachel Reeves, the Chancellor, and that is, I just need to point out that one of the strategies she may adopt, which is more tax rises, not a particularly good idea. And I want to explain why. So why is it that constantly raising tax, which seems like a tempting way to raise revenue, is probably going to backfire? And this is an economist's argument more than it is a political one, quite frankly. Okay, so the government strategy is what? Okay, well, they inherited a black hole in the public finances, as they put it, the size of which is debated, 22 billion sterling perhaps. They feel they need to fill that up. And they needed to spend more on public services such as the NHS and so on. So how do you do it? If you need money as a government, what are your choices? Well, basically, you can put taxes up. That's your regular source of income from consumers and businesses. You can borrow more, but you've got to persuade the bond markets and the so-called vigilantes that they're up for that, if you like. Or you could cut spending on what? On government departments, on NHS managers, who knows? Question then becomes which of those is most likely, to which I don't have an answer or a crystal ball, but raising taxes is tempting. Squeeze firms, squeeze consumers, and generate more revenue for spending on public projects that way. So, what sort of pattern have we seen so far? Well, we're seeing an employer's national insurance rise kick in a few weeks' time. When this video goes out, that's a big one. Penciled in to raise 25 billion, I've heard estimates of that. We've got agricultural property relief and business property relief being cut. In essence, that increases the inheritance tax bill paid by farms, paid by family businesses and so on. And corporation tax in this country, so looking at companies, is already relatively high, higher than it was. That was the previous government. No cuts are planned to the corporation tax regime. So basically businesses and entrepreneurs of one sort or another are being targeted. Now the logic is this. You know, if you look at, say, for example, putting more employers' national insurance, that's the national insurance that employers pay on behalf of employees, onto companies, you think, well, hang on a minute, if they make the same profits and I can increase the tax they pay, national insurance is another word for tax, that should give me, all other things being equal, higher tax revenue. Simple logic. So why might it not? Why might there be potentially no buffer left? You know, 10 billion sterling buffer has been talked about in terms of the gap between the government's revenue and its costs, to put it very, very crudely. And the answer is these tax rises have consequences. All right? Smaller companies that are operating on the margins may go bust. And we're seeing a lot of pressure right now in one sector in particular, that's retail. Now, you might say, well, if you're not running a good business, you deserve to go bust. Brutal view, but certainly these tax increases could tip companies into that position. And once they go bust, they're no longer good for any tax at all, basically. Larger firms, meanwhile, the more stable firms, I'm afraid, won't suck up tax rises. They never do. They have an obligation to their shareholders, all right, more than they do anybody else. So what they'll tend to do, and we've seen this, the bigger retailers, is they'll raise prices to compensate for the extra tax bill they've got to find and or cut costs. All right, and cutting costs, I'm afraid, often falls on staff one way or another, lower bonuses, okay, and or lower pay rises and or redundancies. All right, we've seen rumours of all three circulating. And the ultimate thing to remember, therefore, is that whilst it's tempting for the government to say, well, we'll squeeze companies harder because they can afford it, the reality is the people that actually get squeezed, that actually do the sucking up, are not necessarily the people the government thinks will or should. Then you've got the problem of some entrepreneurs, and I'm not sure whether the Treasury's seen this one coming, simply saying, well, we've enjoyed operating in the UK whilst the tax rules were broadly at least neutral. Now they're changing. Now the direction of travel is becoming clearer. Our direction of travel will be away from the UK. All right? Because don't forget, nimble entrepreneurs can always operate somewhere else. I'm not saying that somewhere else is all good, all better, grass is greener, but they might take the view that in tax terms, the UK looks less attractive than it used to. Okay? The other thing to remember is that if you paint a picture of difficult times, all right, coupled with tax rises, you're going to hit confidence. And confidence matters because it can translate into actual action. You know, the way you feel when you get up in the morning influences how much you spend. The way business directors feel when they get up in the morning influences whether they spend money at all, invest it in new projects, or defer it, or even cut it, or even up sticks altogether and relocate somewhere else. Okay? So it's early days yet. All right, and this is not meant to be a political video, but I would urge the Treasury to think pretty carefully about squashing entrepreneurs, squashing businesses too much, because the signs of its efficacy when it comes to raising tax revenue are at best a little mixed. Okay, enough from me. For other videos on tax, if you'd like to know more about tax, it's killick.com/resources. I've also written at least one guide, it's not this one, little guide on saving tax effectively, killick.com/resources for that. And in Confidant, our planning team, and Paul Killick, of course, quite often take on the issue of taxes and how savers and investors can mitigate them in particular.